That's the problem you get into, because all of a sudden we have 31 trillion debt, just government debt. And it's a lot. It's too much. Nobody does anything about it. But now that's the problem they'll run into, because if they keep those rates up high enough, long enough, then all of a sudden you're going to be screaming from the political side, because they'll be like, hey, we can't afford it.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for January 17th through January 24th, 2023, while supplies last. This week we feature our choice 10-ounce silver bars at just $2.25 over spot per ounce, and backdated quarter-ounce Canadian maple scruffies at only 4% over spot. Frequently, you have to choose between high-volume bars like 1,000-ounce bars to get exceptionally low premiums, or pay a higher premium for more liquidity. But these Our Choice 10-ounce silver bars come from major mints, are 3/9 fine, and provide a great way to stack quickly while maintaining a high degree of liquidity, all at the low premium of just $2.25 over spot per ounce while supplies last. Next, we have quarter-ounce gold maple scruffies at 4% over spot. The Royal Canadian Mint packages quarter-ounce maples in sheets, which most people find inconvenient for storage, trade, or transacting, so they frequently remove them and put them in individual flips or in tubes. As soon as the packaging is removed, they go from being considered brilliant uncirculated to what is called scruffy condition. They may occasionally have a nick or scratch, but by and large are in excellent shape and nearly indistinguishable from their brilliant uncirculated counterparts. And the best part is that these so-called scruffy coins are available at just 4% over spot, much less than the 10 to 15% that you would ordinarily pay for the increased liquidity of quarter-ounce gold. So if you'd like to purchase 10-ounce silver bars at just $2.25 over spot, quarter-ounce Canadian maple scruffies at only 4% over spot, or if you'd like to inquire about any of our other products or services, call us at 1-888-815-4237. That's 1-888-81-LIBERTY. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is Ted Oakley of Oxbow Advisors. Ted, thank you so much for joining us today.
You bet, Elijah.
Well, I wanted today to get your perspective on really your outlook for 2023 for the markets. I know 2022, one of the big stories was that we saw a huge bear market and we saw continuing inflation. Now, you have talked about how really this inflationary cycle is not over. And if you look at what happened in the 70s and 80s, we had kind of ebbs and flows of inflation as the Fed raised and decreased interest rates. What is your perspective on what we're seeing right now and your outlook for inflation, if we can start with that?
Well, Elijah, on inflation, it's interesting. I don't think I've ever seen Wall Street so obsessed with wanting to get us into a recession, so those inflation comes down and the Fed turns around and lowers rates. We don't think it goes that way, only because if you look at a lot of what we call sticky consumer prices and other things underneath, and you look at the input from things, it's interesting. I noticed this morning the Unilever CEO in Taiwan said, "Hey, our costs are still going up. I know it looks like it's probably going down, but everything we're going to be selling has got a higher cost coming in." So we think basically that it's coming down, obviously, from the 9% in June. But now when you get into a territory where you're saying, okay, I'm going to take it below 4 or 5%, then it gets harder. And so we'll just have to see. We'll have to see what type of look we have. But my guess is it'll be a few quarters, maybe a year or so, before you ever go any lower than the 4 or 5.
Now, you have talked about kind of ebbs and flows of inflation and what we saw in the 1970s. Do you anticipate inflation getting better, but then getting worse later?
Depends on the Fed. What happened in the 70s was Arthur Burns, who sort of got run out of town in 1979. He was good. He was there for quite a while. But what would happen is you would have slower times, and he would rush in and lower the rates and not give it time to settle through the economy. What you have to have in inflation is you have to have it settle through the economy on its own time and its own level. When the Fed steps in and tries to control it, then see it's an outside source. And so what happened, he would push in and lower the rates, then it would create an even bigger round of inflation. That happened about 3 times until finally in 79, Paul Volcker came in, and then he took it to a low level and kept it there.
It was pretty dramatic what Paul Volcker did, and it seems like right now what they're doing, even at rates above 4%, that is nothing compared to the, I think, 19% that Paul Volcker had the interest rates at. And I've heard before how you can't really get inflation under control unless you put interest rates above the rate of inflation, which is nowhere near where they are right now.
Well, and I didn't follow up that, but I think this particular Fed, I should say, the problem for them will be this, and that is, if you look at U.S. debt to GDP, okay, it's much higher than it was, 3 times higher than it was at that point in time, late 70s, early 80s. That's the problem you get into, because all of a sudden we have 31 trillion debt, just government debt. And it's a lot. It's too much. Nobody does anything about it. But now that's the problem they'll run into, because if they keep those rates up high enough, long enough, then all of a sudden you're going to be screaming from the political side, because they'll be like, hey, we can't afford it. And whether they have the fortitude to stay with that and not fold is the big question. I can't answer it, but we're certainly watching that.
Now, when it comes to the money supply, last year was actually, you noted this in your forecast for 2023. You mentioned in 2022, it was the first year in very long where we actually saw the M2 money supply contract. So can you expand on the implications of that for the general economy?
Well, one of the things that I call a stealth tightening, okay, it's not, the Fed's not raising rates, but people don't see it, is that first, they're taking a lot of money out of the system. They're also taking a lot of money off of their balance sheet, which means that they're pulling money out in different ways than just raising interest rates. That graph that I had was a 60-year graph. It was the first time in 60 years that the M2 component, which is most of the money, went down. And what that means is that when you start drying up the money, that creates problems in so many areas. It starts in banking, but it really goes over into the leveraged areas and what I call really the sub-economic areas, where you have a lot of junk debt and that kind of thing. And that'll be the first time when that happens. And if they do what they expect they're going to do through the first quarter, then that tightening is just going to keep on accelerating, so that it's going to get harder and harder to borrow money.
And what impact is that going to have on the rest of the markets? Because again, I mean, these rising interest rates, one of the things you've mentioned that rising interest rates really impact also the stock market, because for so many years you've had low interest rates, which has been beneficial for the stock market. But last year we saw a very bearish stock market. So if rates continue to be high, how will that impact stocks?
Well, Elijah, for so long, you've heard this term TINA, which was there is no alternative, to stocks, because rates were so low they couldn't get anything in bonds. And now I call it, there's a new term we would coin like TIA, which is TIA, which is there is an alternative. And that is, you can keep your money short term. I mean, for 4.5% within 6 months to a year and a half in a bulletproof U.S. Treasury. Now that's an alternative. And so that poses some risk in itself. But the biggest problem really, we think, for the recession is we had an interest rate bang up and hurt the markets in 22. In 23, we think it will be an earnings and recession beat up. And that's how that'll come down.
Now, I know for your clients, you are looking at still a lot of liquidity. Liquidity is very important. Having a lot of funds in cash. Can you expand kind of on your strategy going into this continued bear market?
Well, when we say cash, and it is liquid, it's mostly in very, very short-term treasuries. I'm speaking about 90-day or less. So, it's ready cash if we need it. But it's a really good rate of return. It's a lot better in the money market. But what's happened, and what happened with us in 22, is we had a high degree of liquidity. So it allowed us to beat virtually all the markets. Not because we're the brightest people in the room, just because we had liquidity. And so you can't get hurt if you've got liquidity. Now, you can give up opportunity if you're not in the markets when they're going higher. I understand that. We didn't have that problem in 22, and I don't think we'll have that problem for a while in 23. I think a lot of people think that. That's why you've seen this rush into the markets the last 2 or 3 weeks. But I think a lot of that is people coming back to these crazy meme stocks and Bitcoin and all the speculative things that were going on in 21. Well, they sort of raised their head again, and we don't think that'll last either. So when you get into a really severe earnings recession, then everything has to recalibrate.
Now, I know how really in 22, if you didn't lose, you won, right? And I think having a lot in cash or short-term treasuries gets you that, right? You may stay stable, but you're not losing like the rest of the markets. Also, we saw gold kind of do the same thing, pretty much flat for the year. What is your immediate outlook for gold? Because I know recently we've seen quite a bit of a rally to start the year here. Are you still bullish on gold? Are you still holding gold? Your perspective?
Well, we still hold it in 2 of the 3 strategies, and in one of the strategies, which is what we call a high income strategy, we also have the miners. So we have both, and we've always had a position. It ranges anywhere between 4 and 6% of those 2 strategies, and we're at the upper limit right now because we really added some back when they were somewhat cheaper on the miners. So we think it has more to go, and it could have a lot more to go. We'll have to see, but we just feel like people probably don't realize, but this particular century, the 2000, since 2000, gold was the #1 performer. People forget about that.
And it sounds like you're possibly looking for it to continue like that. What conditions have to be met for gold to continue to rise? Well,
it typically, now whether it disconnects, I don't know, but normally it will run on one of two things. Either the world becomes so discombobulated that people are so worried about everything, even their own currencies, et cetera. And we've had more countries, central banks, buy gold in the last 5 years than we've seen in a long, long time. So that's one thing that can push it higher and keep it going. The second thing is, and I don't know that this would happen, but gold tends to do really well when the interest rates are coming down. But whether that stays that way, it gets into real rates and that sort of thing. But we'll have to see. But that when you get into negative real rates, that's where you head with gold. But that's where we are right now. And I don't know which one will take place, but I think something will keep gold fairly firm now.
I know many people are looking for a short-term pullback here. Is that something you're concerned about? I'm assuming you're probably looking more long-term, but I know some people are looking for a short-term pullback given the amount that gold has risen recently.
I suppose, Elijah, you could get some selling. Basically it's gone from, call it 1750 to 1920 per ounce, and sometimes you get selling based on that. I know when you went under 1800 and the 1700s, people were like, hey, we're out of here. It's going to 1200 or 1300. I'm not a big technician on that side, so I don't buy into that very much. But yeah, you could get some selling, I guess. I think people need to take a little longer term view on gold than trying to trade the in and out. That's hard to do.
Now, moving forward here to the real estate market, I know you've mentioned how rising interest rates have a very negative impact on real estate kind of across the board. What have we seen recently? I know prices have come down significantly, and what are you looking for in 2023?
Well, I think people are underestimating a couple of things. Now, you have a holdover on residential building and commercial building and multifamily building that was coming from the last 12 or 18 months because the money was lined up. They were already approved. They could come out of the ground. See, we're getting to the end of that, though. And so new projects are going to be tough to come by. That do anything. You're also going to have a tremendous amount of footage that's available, I think, in commercial buildings. I don't think the work from home thing is completely over. I think people still tend to work from home. So it makes these companies go the other way. But I think real estate is a big, big piece of the U.S. economy, not only residential, but commercial, and you have a lot of believers in it. So, and we do believe in it too. I don't mean to imply we don't, because we've owned a lot of real estate over the years, but we haven't bought anything the last year and a half or so. But we believe in it. We just don't think now is the time, and we think the damage has further to go, because you've just now gotten into a period where people, have said, well, I won't sell my home now, but then all of a sudden they have to because their job moves them or they have a family situation. There's a lot of things come into play. And, if you have a home with a 3% mortgage and you want to buy the same home with a 7% mortgage, that's going to take a big chunk of your earnings.
And I know, for example, in 2008, we saw the crash of the housing market really ripple throughout the economy. How do you see the impact of this coming, or, the housing market falling right now? And if it's going to fall further, how do you see that impacting the overall economy?
Well, for housing, you could buoy it a bit, I suppose, with bill for rent, because bill for rent's a pretty big number of 25 or 30% of what's being built. I think they're overbuilding that particular industry, but that's left to be seen. But I think what happens is, as you go forward here, all of this is just now coming to the point where it's really rolls over, because you're getting the point where the builders, for example, they can't borrow any money from the banks. The banks have said, hey, we're going to cut back on the specs. We're going to cut back on, if you've got a custom, that's one thing. There's not many customs right now. So all of that, you put all that together, and it's hard for us to see that you don't keep pressure on the market. I'm not saying it'll be like an 08, because 08 was a financing crisis. You couldn't get the money, okay? Everything went away. This is different. This is an economic crisis where the prices are down, the interest rate on the loan is up, and those two are colliding, and then all of a sudden it creates, softness.
You mentioned how this time it's different. It's a financial crisis this time. Before we let you go, if you could leave with our viewers maybe a few tips to kind of fortify themselves for this financial crisis that we're heading into.
Just in general, if I were recommending something to your viewers, it would be, since we don't know what's going to happen this year, it's not going to hurt you to hold some liquidity, like I say, at 4.5% in a treasury. Here's the reason why. Let's just say the S&P is up 5% this year, and you're in a treasury of 4.5% for the next year. You didn't leave much on the table, and you didn't take any risk, okay? Now, if you think the S&P is going to be up 20 or 30%, that's one thing. We don't think that. We think that you're going to go through an earnings problem, which will create a market problem. And now, there'll be a great piece of opportunity there. That's why I say to people, hold some liquidity. I'm not telling you to get out of the market completely, but if you can hold a third of your money or so liquid or more, then when the time comes and you get a good opportunity, if we get that this year, that'll make you some money.
All right. Well, Ted Oakley, we really appreciate your time today. Where can our viewers find you online if they're interested in learning more?
The best place, Elijah, is just to go to our website, oxbowadvisors.com, and everything's there. All the pieces we do, the interviews we do, all of the books we write. Be happy to send you any of that information anybody wants, and certainly wish everybody a Happy New Year this year.
Definitely. Happy New Year to you too, Ted. Thank you so much for your time, and God bless.
You bet.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.